Welcome back to the Pro Ticker Podcast, your Wednesday morning edition, covering major financial magazine headlines, everyone.
Right.
Today, we're going to be diving into the global markets, pulling insights from CNBC, Bloomberg, and the Wall Street Journal.
Oh, wow. Sound like we got a lot to cover.
Yeah, we definitely do. Let's start things off with CNBC and their report on the Asia-Pacific markets opening mixed.
Okay.
President Trump's tariff plans and all this talk about a potential recession are really making things interesting.
Yeah, it's really kind of wild how these pronouncements from world leaders can just send these shockwaves through global markets, right? You can just feel the uncertainty in the air.
You really can. It's like everyone's trying to figure out what's going to happen next. CNBC mentioned how Australia's S&P ASX 200 closed lower,
Yeah.
while markets in Japan and South Korea actually saw some gains.
Interesting.
It just shows how differently economies are reacting to everything that's going on around the world.
Exactly. Some see it as a chance to maybe make some moves while others are playing it safe, waiting to see what happens next. It's all a big game of strategy and perception.
It really is. And speaking of high stakes, let's talk about those tariffs. Trump's 25% tariffs on steel and aluminum are officially in effect.
Oh, boy.
And the EU retaliated with their own tariffs on U.S. goods, a whopping 26 billion euros worth, impacting everything from soybeans and bourbon to boats and motorcycles. Bloomberg really broke it all down for us.
Yeah, this whole situation just shows how complicated international trade can be.
Right.
These retaliatory tariffs aren't just about protecting industries at home.
Right.
They can have a huge impact on the entire global supply chain.
So it's not just between the U.S. and the EU.
Right.
It affects everyone.
Exactly. And then you add in the uncertainty around Trump's trade policies, like when he threatened to double tariffs on Canadian steel and aluminum.
Oh, yeah.
And then Back Down and MarketWatch covered that one. And it just adds to the anxiety. Businesses need to be able to plan ahead. And this unpredictability can really stifle investment and economic growth.
That's a good point. And despite all of this, the EU seems pretty firm in their stance against the U.S. tariffs. Their response really highlights how global trade dynamics are changing.
Absolutely. They're basically saying they're not going to back down. This whole situation could reshape trade relationships globally, affecting economies like China and India, too, as they try to figure out this new landscape.
It's like we're seeing a whole realignment of global economic power.
You could say that.
Meanwhile, back in the U.S., the market's on edge about inflation and that upcoming CPI data release. Bloomberg's analysis really highlighted that.
It's a delicate balance between inflation, interest rates, and how everyone's feeling about the market.
So everyone's waiting to see if inflation's going to calm down.
Right, exactly. The SIBO Volatility Index, which basically measures how much the market thinks prices will swing, is up, which means people are nervous. The higher it goes, the more fear there is in the market.
It's like a fear gauge.
A pretty good analogy, actually. And speaking of navigating uncertain times, Bloomberg had this really interesting article about JP Morgan's strategic indices business and their $100 billion quant-driven trading strategy.
Wow.
They're offering institutional investors access to hedge fund-like returns, but at a lower cost using these quantitative investment strategies, or QIS.
Okay, break down this QIS thing for me. What's the big idea?
So picture this. You have this computer program that crunches through mountains of data,
Okay.
looking for tiny trends or patterns that can be used to make money. That's QIS in a nutshell.
So it's like having a team of super analysts working nonstop.
You could say that QIS can be super efficient and potentially very profitable.
I bet, but I imagine it has its critics.
Oh, of course. Some people argue that these strategies are too rigid. They don't adapt as well as human managers, especially when things in the market change quickly.
That makes sense.
And then there's the issue of crowding. When too many investors pile into the same trades,
Oh, yeah.
it can actually reduce the returns.
So like everyone trying to get through the same door at the same time.
Exactly. And it makes you wonder about the future of investing.
Hmm.
Will these quant strategies completely replace human fund managers?
Wow.
Or will both approaches continue to exist side by side?
That's a really interesting question.
It is. And while some companies are embracing tech-driven strategies, others are facing challenges even when they're doing well.
Okay.
Let's talk about Oracle for a second. They've been landing some huge cloud contracts, but their stock is actually going down. MarketWatch had a good piece on this.
That's surprising. You'd think landing big contracts would be good for their stock. What's the deal there?
It's a good example of how the stock market sometimes focuses on short-term costs instead of long-term potential.
Okay.
Investors are worried about Oracle's rising data center costs even though those investments are meant to build a strong cloud infrastructure that could lead to huge profits later on.
So it's like they're being punished for investing in the future.
Pretty much, and it's a good lesson for investors, especially in fast-moving sectors like cloud computing.
Right.
You really need to understand a company's investment strategies and their long-term impact.
And finally, to wrap up this whirlwind tour of the global markets,
Well,
it looks like Goldman Sachs is taking a more cautious view of the U.S. market.
interesting.
They lowered their S&P 500 target, but they're actually more optimistic about European earnings. Bloomberg had the details on their revised outlook.
Yeah, it's a pretty big shift. They're pointing to a few things: slower GDP growth forecasts for the U.S.,
Uh-huh.
the impact of the tariffs, and the general increase in uncertainty.
Yeah.
They seem to think Europe has more growth potential right now compared to the U.S.
So Europe's on the upswing while the U.S. is facing some headwinds.
That's one way to look at it. The global economic landscape is always changing, and investors are always trying to figure out where the opportunities and risks are.
Absolutely. And that concludes part one of our deep dive into the global markets. We'll be back with more insights and analysis right after this quick break.
Welcome back, everyone. Let's jump back into those financial headlines.
Yeah, before we move on too far, I want to circle back to those tariffs with Canada for a second. MarketWatch had a piece on that. Remember Trump's threat to raise those tariffs on Canadian metals?
Oh, right, yeah.
Turns out it was because of Ontario's new trade restriction, that 25% surcharge on electricity exports to 3 U.S. states.
Ah, yes. The Ontario thing, it just shows how regional policies can escalate into these international trade disputes. It's like a domino effect. One little action can have huge consequences globally.
It really shows how interconnected everything is, but thankfully it seems like things calmed down. MarketWatch reported that Ontario suspended the surcharge and Trump backed off the tariff hike.
Diplomacy in action, sometimes it's better to talk things out than to throw your weight around.
Absolutely. Speaking of averting disaster, let's talk about that possibility of a recession. Barron's mentioned that even President Trump himself acknowledged it as a possibility this year.
Yeah, that's right. When even the optimists start talking about a downturn, it can really shake market confidence.
It definitely makes you think.
It does. It highlights the importance of spreading your investments around. Don't put all your eggs in one basket, as they say.
Exactly.
Yeah.
And on that note, let's go back to JP Morgan's quant-driven trading strategy for a minute. Remember that Bloomberg article about their strategic indices business?
Yeah.
It turns out even hedge funds who usually see these products as competition are starting to use them.
Interesting.
It's pretty surprising. You'd think hedge funds, with their focus on big returns and complex strategies, wouldn't be into these quantitative approaches.
Yeah, it's a fascinating development. It suggests that even the most experienced investors see the potential in QIS, especially when it comes to efficiency and cost effectiveness. It really shows how the financial industry is changing, with technology playing a bigger and bigger role.
It makes you wonder if these quant strategies are the future, or if there will always be a place for human intuition and expertise.
It's a big question, isn't it? It's likely both approaches will stick around, each with its own strengths and weaknesses for investors. The important thing is to understand the risks and potential rewards of each strategy and make smart decisions based on their own goals and risk tolerance.
So it's about finding the right balance, not necessarily one replacing the other.
Exactly. Now let's shift gears and go back to that Oracle story and their cloud computing push. Remember that MarketWatch article about their stock performance?
Yeah.
They're winning these huge cloud contracts, but their stock is dropping because investors are worried about rising data center costs.
It's a strange situation. They're doing well, but getting punished for it in the market, it's like people can't see the big picture.
What's happening here is that the market is focusing on short-term expenses instead of long-term growth potential. Building a strong cloud infrastructure takes a lot of upfront investment, which can impact profits in the short term. But if those investments lead to continued growth in cloud revenue, it could mean bigger profits and a higher stock price later on.
So it's about patience and understanding the long game when it comes to companies like Oracle.
Exactly. Investors need to see beyond the immediate costs and look at the company's long-term vision.
And zooming out to the bigger picture, let's talk about Goldman Sachs's revised outlook. Bloomberg reported on that it seems like they're feeling more positive about European markets.
They are. They actually lowered their target for the S&P 500 because of worries about slower U.S. GDP growth, the ongoing tariff situation, and the general uncertainty.
I see.
But they've upgraded their earnings outlook for European stocks, which suggests they think Europe's economy is looking better.
So are European markets becoming a safe haven in all this U.S. turmoil?
It's possible. Of course, we have to remember that global markets are all connected. What happens in one place can affect everywhere else, but for now, it looks like some investors are turning to Europe for stability and growth.
It's like a constant game of shifting positions based on what's happening globally and with economic indicators. Now, before we wrap up this part of our deep dive, let's focus back on those trade policies that are keeping everyone on edge.
Welcome back to the last part of our deep dive. It's been pretty intense so far.
It really has. We've talked about everything from those mixed market reactions in Asia Pacific to the trade war between the U.S. and the EU.
Yeah.
Speaking of that trade war,
Yeah.
I want to get your take on the potential long-term effects of President Trump's tariffs on steel and aluminum.
It's a tough one to call. MarketWatch and Bloomberg have been all over it, and it's definitely still playing out. The EU's retaliatory tariffs targeting 26 billion euros worth of U.S. goods are a big deal.
Yeah.
This back and forth could easily turn into a full-blown trade war with huge consequences for everyone involved.
It's like they're both daring each other to back down, but
Yeah.
what happens if neither of them does?
Well, the most immediate impact would probably be on consumers. Prices could go up on all sorts of things, from everyday stuff to bigger purchases.
All right.
Businesses could also take a hit with supply chains getting disrupted and access to important markets being limited.
Makes sense.
In the long run, these trade barriers could really stifle economic growth and innovation, which would hurt everyone.
So it's a lose-lose situation. Do you think there's any chance they'll work it out, or are we stuck with this trade war?
It's hard to say the current administration seems pretty set on these protectionist policies, but you never know. They might come to some kind of agreement.
Right.
But to do that, both sides have to be willing to compromise, which hasn't always been the case.
It's a tough balance trying to protect industries at home without hurting the economy as a whole. And speaking of economic worries, let's talk about that possibility of a recession. Barron's said that even President Trump admitted it could happen this year.
It's true, a bunch of things are pointing in that direction. Rising interest rates, trade tensions, geopolitical uncertainty.
Yeah.
When you add all that to what President Trump said, it's not surprising that people are worried.
So with all this uncertainty, what advice do you have for investors? How can
Well,
they protect themselves?
It's definitely a tricky time, but there are things investors can do to reduce risks and maybe even take advantage of the ups and downs. The most important thing is diversification.
Okay.
Spread your investments across different types of assets, different industries, and different parts of the world.
Don't put all your eggs in one basket.
Exactly. It's also important to stay informed, keep up with economic indicators, political developments, and market trends.
Right.
Don't be afraid to adjust your strategy as things change, and maybe most importantly, don't panic. Market downturns are normal. They're part of the cycle. If you stay calm, stay informed, and make smart decisions, you can get through it and come out stronger on the other side.
That's great advice to end our deep dive into the global markets. Thanks for joining us. We'll be back tomorrow morning with more headlines from the financial world.